first presentation will be from Kevin from M&T Bank, and it will be on LIBOR and SOFR. And then the second presentation will be from two of our own Bonadillo partners, as well as our tax principal, and this will be a year-end financial reporting update. And then lastly, this is just our slide indicating to you that this information is for general educational purposes and it is not specific advice, and that it is the opinions and statements of the individuals that are presenting and not necessarily the opinions of the firm or the institution from which the presenter is from. So please join me in welcoming Kevin. He is the Vice President of Accounting Policy from M&T Bank. He will kick off our seminar this morning with a LIBOR and SOFR update. Thanks, Kevin.
Okay, thank you. Welcome, everybody. Unfortunately, we can't be in person as indicated earlier, but I think we can make this work. So today, I'm going to talk about a few topics, mainly the LIBOR transition from LIBOR to SOFR that's going to be occurring over the next few years. Talk a little bit about the ARC and some of the accounting guidance that goes along with that, and then touch a little bit on some of the COVID TDR exemption accounting guidance, and then I have one slide on accounting for PPP loans. So that'll be our agenda for today. So let's get started with the LIBOR transition. So starting off, I'm sure everyone knows what it is, but what is LIBOR, right? So LIBOR is it's a rate that's made up of an average of interest rates that major global banks lend to one another. And this rate's administered by the ICE, which is the Intercontinental Exchange, and it's used as a benchmark index for banks when they're setting their variable rate loans to borrowers. And it's also used for setting fixed rate loans. The index is part of the fixed rate loan. So you start off with the LIBOR rate plus a spread, and then you'll lock it in as a fixed rate loan. So it's a very universal index that's used today, but unfortunately it's going to go away. And why is it going away? It's going away due to a manipulation scheme in which certain banks that are in this LIBOR panel, they provided interest rate figures that didn't reflect what the rate was that they could borrow. So as a result of that, the United Kingdom's Financial Conduct Authority, which is the regulator of LIBOR, they announced the discontinuation of LIBOR. So when they announced the discontinuation of LIBOR, they had to figure out, okay, what's going to be that new reference rate that folks are going to use to set their loans to borrowers and things of that nature. And it's also used for derivatives and swaps and things of that nature. When you're talking about interest rate swaps, it's the index and the variable leg of an interest rate swap. It's also used as the discount rate for a lot of swaps until the recent change where they switched that over to SOFR. So basically the FCA announced the discontinuation of LIBOR, and they worked with the banks that are still remaining on this panel to set up an end date for LIBOR. And they set that end date up to be at the end of 2021. However, most recently, just a couple weeks ago, back on November 30th, a proposal was issued to push back that end date to June 30th, 2023 for basically all the tenors of LIBOR except for the 1 week and the 2 month tenor. That's still scheduled to go at December 31, 2021. Not sure how they picked those two to survive or to continue to meet that original deadline of 2021, but that's the proposal that's out there. Right now, there's comments that are due on that proposal by the end of January. They put it out there as a public proposal get feedback from folks on that, and that's currently supported by the Federal Reserve here in the U.S. So they're very supportive of pushing that date back for the at least the main tenors of LIBOR, which is generally the 1 month and 3 month are the main tenors of LIBOR. So I think a lot of that pushback date has to do with the fact of where we are today in the pandemic world and just trying to work through all the issues that have to be worked through, and it's just a little bit more difficult than they originally thought given our current situation. So in terms of this LIBOR transition, this moving off of LIBOR, how's that being handled here in the U.S.? So in the U.S., the Board of Governors of the Federal Reserve System and the New York Fed got together and they established what's called the Alternative Reference Rate Committee, also known as the ARC. And the purpose of the ARC is to identify the potential alternative reference rates to be used, and also to develop some best practices to implement the new rate so it can get implemented appropriately here in the U.S. So the ARC is comprised of a group of market participants, and it was, like I said, it was charged with finding a rate that would be a robust rate within the market, and that would comply with a bunch of standards, including the IOSCO standards for financial benchmarks. And IOSCO is the International Organization of Securities Commissioners, so they want to make sure that it works for that group as well. So a lot of acronyms here, but it's all basically all the groups that are involved with benchmark interest rates and things of that nature. And the ARC was also charged with coming up, as I mentioned, with best practices and how do you get this implemented here in the U.S. So there's a website you can go to. You can Google ARC and you can get right to the website on the Federal Reserve, and there's just a boatload of information out there about it. They have fact sheets, they have best practices documents, things of that nature you could all refer to, which is very helpful for helping in the implementation of this transition. But after discussing the rate, potential new rate, they did come out with a rate called the Secured Overnight Financing Rate, also known as SOFR, and that's the recommended alternative in the U.S. to LIBOR. It's as I indicated, it's a secured overnight rate. It's an overnight repo rate that it's based on. So the fact that it's an overnight repo rate and it's a secured rate, it's a little bit different than LIBOR in that LIBOR actually, people think about it as being a kind of a risk-free rate, but it's really not. LIBOR actually has some credit risk in it, and it has credit risk in it because it's based off of, as I indicated earlier, the rate that banks can lend it to each other. So there is some credit risk in that. So one of the challenges for this new SOFR rate, that this overnight rate, and the fact that it's secured, is that when there's a flight to quality, the rate will drop. Prices increase, rates drop. So what ends up happening there is you could have some anomalies with that rate dropping. Whereas in LIBOR, when you have a flight to quality, while the LIBOR, the benchmark rate in the LIBOR may drop, the credit spread on the LIBOR expands. So you don't get that big drop in the rate that would otherwise occur in a risk-free rate world, which the overnight secured rate is all about. So what they're working on now is well, how do we put some kind of a spread into that rate that could handle that situation where you have kind of a flight to quality. So right now they started off with a rate that says, okay, we have a SOFR rate. We know the SOFR rate is less than the LIBOR rate, so we have to come up with at least initial spread to make it even on day one. That initial spread they're coming up with is a fixed spread, and that fixed spread was based on years and years of analysis to determine an average. So they come up with this average, and they're going to apply that fixed spread to the SOFR rate to kind of give you a day one equivalent LIBOR. But they're also working on a dynamic rate that hopefully will be in play now that things are being pushed out to 2023. Hopefully that dynamic rate will be ready by 2023, so that you can have that same kind of phenomenon that you have in LIBOR. So when you have a flight to quality, that rate doesn't necessarily drop dramatically, which you don't want that to occur. You want to keep a little bit of a credit spread on there so that you get your appropriate return on your variable rate loans. So that's something to keep in mind and keep a lookout for when as they're working through these adding the spread to the SOFR rate. Let's slide over to the next slide here. So, as I mentioned, part of the ARC is to come up with some best practices. So they came up with a list of best practices for companies to follow. One of them is that you should have an entity-wide program and governance structure to prepare for the transition. It's just not a a one department kind of implementation. It takes a lot of departments within the organization. You have the accounting department, you have your treasury department, you have your ALCO group involved, you have your compliance groups involved. So there's a lot of groups involved within the organization. So it's best to set up at our bank at M&T we have a LIBOR transition group set up, and so that LIBOR transition group consists of all the different departments that are being impacted by LIBOR and the LIBOR transition. And so that's probably the first thing y'all should do is when you're thinking about this, let's make sure we have all the right parties within the organization involved in this group to make sure that all we dot our I's and cross all our T's as it relates to this transition. So one of the things you got to be thinking about is you have to evaluate and mitigate the risks that are associated with the products that you have in your client exposures. So that's part of the best practices. You come up with that evaluation that you have to do. You have to quantify your LIBOR exposures, right? So you have your LIBOR exposures as it relates to your loans. You may have your LIBOR exposures as it relates to your swaps. So quantify that within the organization. How much of your loan book is going to be impacted by the LIBOR transition? Is it 10%, 20%, 50%, 70%? It could be quite large if you have a big variable rate lending book. And then same thing on the swaps. If you have a lot of swaps that you have with your customers, because in a lot of cases you may give some variable loans. Customer want a fixed loan, so you swap that out for the customer, but then you have to go and get another swap, call it back to back, to put you back in a variable rate position that you want to be in. So there's a lot of pieces to the puzzle here that you have to be thinking about when you're evaluating your exposures to LIBOR and what that's going to look like when you switch over to SOFR. And then you also have to be thinking about your pricing capabilities. When you think about SOFR, there's a few different pricing capabilities with SOFR. There's SOFR in advance. So you pick the SOFR rate in advance of the month that you're going to be charging the interest. There's SOFR in arrears, which seems to be the direction that the ARC is going in with the SOFR in arrears. There's simple compounding. There's simple SOFR. There's compounding SOFR. So there's a number of different conventions of SOFR you could use. I think right now they're looking at what the ARC is recommending is SOFR in arrears compounding. So again, you can go over to the ARC website. You can check out some of these different conventions they're thinking about, and they have examples on the website, which is very helpful. So there's a lot of good background information to utilize when you have to go through this process. And then also you have to be thinking about the fallback language that you have to put into your contract. So a lot of contracts now, they have LIBOR as the base rate. Within those contracts, you have a fallback language. What happens if LIBOR should not be posted for a day or a month, for example? So what happens? What do you charge, right? So a lot of contracts now have a different rate. Now, prime, for example, is a fallback rate in those contracts. So now you have to think about changing those contracts from, especially if they're longer-term contracts and they're going to go out beyond the changeover date. You have to think about changing the fallback language in those contracts to SOFR, so that when LIBOR actually goes away in 2021 and 2023, it'll automatically switch over to SOFR. So you have to have those discussions with your clients and the borrowers to ensure that you get that proper fallback language into the contracts. And again, the ARC has some recommended fallback language within their the best practices. So again, go to that website, check that out, and you can get some good information from there. And then lastly, from this slide, you also have to understand the accounting and tax consequences associated with the transition. So some additional best practices. As I indicated, you have to incorporate the ARC conventions into the contracts. So that fallback language, you would need to put it into your existing contracts, But you also have to think about it as you're going forward with your new contracts. And you may even want to think about switching over to SOFR now for some of your contracts and doing the trial run and say, okay, let's try a contract with the SOFR rate or a couple contracts with the SOFR rate and see how that works. It's a good opportunity to do that now before everything switches over. But you have to be thinking about it for your existing contracts as well as any new contracts that you're coming out with tomorrow. And instead of putting the old fallback language in there that related to prime, put the new fallback language in there that relates to SOFR. You also have to be thinking about disclosures. And as you're starting to work through this, what do we have to think about from our disclosure package when we're announcing this to the world that we're switching over to SOFR? You might want to start disclosing what that replacement rate is that you're going to be using, which would be SOFR, and then maybe talk a little bit about the spread adjustments that are involved in that. Now, you don't necessarily have to switch to SOFR. There are other reference rates out there. The ARC is recommending SOFR. It is voluntary, but I think the majority of the U.S. is going to go there. The big banks are all going there. I think all the regional banks are going there. So that's probably the thing to do is you want to be consistent with what I would think the majority of organizations and banking institutions are going to be going to. And then you have to think about if you're involved in any of your swap contracts, you might want to think about initiating some new SOFR derivative contracts. I think it was back in mid-November they did have the changeover from on the discount rate on derivative on swaps. They changed the discount rate from the overnight the Fed funds overnight rate to the SOFR rate. So now swaps are discounted on SOFR. They still haven't made the change over to the variable rate, the variable lag in the swap being a SOFR rate yet. That's going to occur. That'll occur at the changeover in probably 2021 into 2021. But they did change the discount rate. So you do have some different valuations occurring as a result of that change in that discount rate. Okay, so now we have our first polling question. We'll do that before we switch over to some of the accounting guidance. So the first polling question is, which organization regulates LIBOR? Is it A, the Alternative Reference Rate Committee, ARC? Is it the Federal Reserve Bank of New York? Is it the Financial Conduct Authority, the FCA, which is out of Great Britain? Or is it the Environmental Protection Agency, the EPA? We'll give you another 30 seconds or so, or another minute or so on that.
Okay, I'll go ahead and close the poll in a couple seconds here, okay?
Thank you. Okay, so poll is closed. It looks like the majority of respondents responded to the FCA, which is the correct answer on that one. So the ARC is I think the second was the ARC. That was the one that's basically in charge of the moving off the LIBOR here in the U.S. Okay, so let's turn our attention now to some of the accounting guidance that's related to the transition, which is back in March of 2020, the Financial Accounting Standards Board issued ASU 2020-04 to provide accounting guidance via optional expedients. That accounting guidance is labeled as reference rate reform because they didn't really want to specify within that accounting guidance that the change would be over to SOFR. They're just saying, well, whatever that change is from LIBOR, whatever you change it over to, these optional expedients would apply to that. The optional expedients apply to a number of different types of contracts, with loan contracts being probably the biggest, but also derivatives, so your swaps and your options, and also to your hedging relationships, because there's a big impact to hedging relationships as things switch over from LIBOR to SOFR, because it impacts both the loan side as well as the swap side. So you have your hedging relationships that are impacted by that as well. So for the loan, the expedients basically allow bypassing the guidance in ASC topic 310 relating to the continuation of an existing loan versus a new loan, and so you would apply that guidance in 310 normally if you had a modification to a loan. These expedients allow you to bypass that guidance and just basically ignore it and move on as if nothing happened. You just revalue everything under the new rate. For derivatives and hedging, it allows for bypassing the analysis of whether the terms have changed, resulting in a potential dedesignation event or an ineffectiveness event. The issue here, though, with these practical expedients, these optional expedients, is they have limits, and the modifications that you make to your contracts, in order to get the practical expedients, the modifications have to be related to the replacement of LIBOR and not for other reasons. So the fact that you have an opportunity here to make modifications to loans and things of that nature, you might say, well, geez, in addition to going into making a modification to a loan for LIBOR, maybe I'll make another modification. Well, if you do that, there's a potential that you may not get that practical expedient may not apply, and then you have to go back and apply the regular accounting guidance in those situations. So the next slide here, this provides some examples of modifications that would be related to the replacement of LIBOR. So I won't go through every one of them, but obviously changes to the reference interest rate. So when you change from LIBOR to another interest rate index, such as the SOFR, that's related to the replacement of LIBOR. You're fine on that. You make that change, you move ahead. Also another one is the change to the spread adjustment, because the LIBOR and the SOFR are not exact rates. So let's say you have a loan right now that's a LIBOR plus 200 basis points. That's your loan. Well, when you switch over to SOFR, the SOFR equivalent of LIBOR may be SOFR, and I'm making these up, so don't quote me on these, but the replacement of LIBOR replacement might be 3-month LIBOR, might be for SOFR, it might be SOFR plus 25 basis points. So now what you're going to do is you're going to have a SOFR loan would be SOFR plus 225 basis points, something of that nature, because you had to add that additional spread on there so that at least your initial LIBOR transition was the same. So LIBOR is the equivalent of SOFR plus 25 basis points. So you do that, add that spread adjustment, and then you have your regular spread adjustment that was on top of that from your regular loan in the past that had maybe 200 basis points attached to it. So adding that additional spread adjustment is acceptable as well.
Kevin, we did have a question come in. Someone inquired as to whether or not, what if a borrower does not want to convert their loan rate to SOFR? Can we force them to do so anyway? I assume that it's a negotiation with modifying the terms, but could you comment on that, please?
Yes, it definitely would be a negotiation, and you don't have to force that on them. And a lot of times, you have to work with the customer and say, okay, well then what do we want to make this, right? So you could change it over to Prime, but Prime, I think it's not probably in the best interest of the customer to switch to Prime, because Prime is a higher index. So you might have to do, if you want to have an equivalent index, you might have to do Prime minus instead of LIBOR plus. You do Prime minus, something of that nature. But it's definitely not required. And if you get pushback from your customers on that, then you work with a different index. and switching over from LIBOR to prime, for example, that is acceptable within the reference rate reform guidance. So you could do that without having to, with still getting the practical expedient. So that's fine to do. So that's why I had mentioned about the fallback language. So you want to work with your customers, and you want to start doing that now, and having those discussions with your customers to say, okay, maybe you don't even have fallback language in your contracts now, but if you do, work with the customers and say, hey, we have prime in there now. You know, the world is going to SOFR, the U.S. is going to SOFR. We're looking to go to SOFR here at our bank, and you know, here's the benefits of it versus prime. So you'll have those discussions with the customer, but if they're still uncomfortable with it, then you know that's fine. You switch to prime, or maybe you could switch to the Fed funds rate. You could do that as well. So there's some other indexes out there that you could switch to in addition to SOFR. So not a problem at all. Work with your borrowers on that. So a couple of the other changes you can make. You could change the reset period. Maybe you reset LIBOR monthly. Now on SOFR you're going to reset SOFR every 3 months, for example. That's fine to do that. Set the reset period, the reset dates, business day conventions. So those are all things that are acceptable as part of the reference rate reform guidance that allows you to get the practical expedience. You could add some interest rate caps and floors as long as when you add them they're out of the money. If they're in the money, then they would not be considered an acceptable change to make that would allow you to get the practical expedient. You could do it, but then you have to apply the regular accounting guidance that would come into play. But you could do a cap or floor, for example, that's out of the money, and that would be acceptable. So here's a list of some of the things that are acceptable, and it's just a list. It's in the accounting guidance itself, right within the ASU, and so you could pull the information from there as to what's acceptable for still falling within and getting the practical expedience. The next slide is a listing of some of the things, some of the modifications that would not be considered related to LIBOR, and therefore, if these were part of the modifications that were made, then you would have to apply the existing modification guidance within GAAP related to loans within ASC 310 and within derivatives in ASC 815. So a couple of examples, on the derivative, if you change the notional amount, that would not qualify for the practical expedient. Changes to maturity date. So if you have a loan that matures in 2 years, now you want to make it a 5-year loan, well then that would not be acceptable for getting kind of the free pass. If you change from the loan that's a variable rate loan, you change to a fixed rate loan, that also would not be acceptable because then you're changing the terms that would be more than just flipping from a LIBOR to a SOFR, for example. So there's a number of these changes on here that would not be acceptable. So I don't want to go through all of them, but when you get a chance, go through that list, and then as you're talking through that as an organization, and you maybe have an opportunity to make some additional mods to the loans, take a look at here and see what's acceptable and then what's not acceptable. Not to say you can't do it, because if you want to still make those additional modifications, you would not get the free pass, but you still, when you apply the existing accounting guidance, it may not have a major impact that you would otherwise think it would have. So it's still something you could think about doing, but just keep in mind when you would get the free pass and when you would not necessarily get the free pass. Okay, so now we have a second polling question. Which of the following is an example of a modification not related to the replacement of LIBOR? Changes to the strike price of an existing interest rate option, changes to the notional amount of an interest rate swap, addition of an interest rate floor that is out of the money, changes to the reset period for a variable rate loan. So go ahead and take a minute or so, think about that. I'll leave the poll open for another little while. and then I'll just talk a little bit about consequences of falling outside the safe harbor and what you have to be thinking about there.
Kevin, while we're wrapping this up, do you want to take a peek? There's another question in the chat, or I can read it to you too, whatever your preference is.
Oh, yeah, I think read it to me. Yeah, because I got a lot of things on the page here. Yep.
Yep, I will do that in a second. I'll close the poll very soon. Okay, so the poll is closed. So the question is, do you expect that the typical borrower is going to attempt to capitalize on this situation to, in effect, renegotiate the terms of their loans? What recourse do we have if a borrower makes this difficult? Do you see lenders viewing this as an opportunity to steal customers with refis under more generous terms?
Yeah, that's a good question. I think my thinking is, if you educate the borrower to what's going on, and all you're trying to do basically is change things over so that things are even in terms of the rate. If they feel that their rate is too high, they would have felt that way today under LIBOR. So then that becomes a negotiation with that borrower to try to keep them as a customer. And there are some things that you could do from a loan perspective. I think, and I'll get into that in a minute here, but I think making the modifications to the loans, even if you fell outside of the optional expedients to kind of give you the free pass, it takes a lot to modify a loan, or the impact of the modification of a loan takes a lot to basically fall outside of the accounting guidance that would cause you to have to fair value the instrument and think about it from a different perspective than you do today. So I think you have some room there, even if you have to go into those negotiations and change some other terms. From a loan perspective, I think you have a pretty good runway there before you really get impacted. Even though you have to apply the guidance and don't get the free pass, you have a pretty long runway there before you have any negative consequences, at least from an accounting perspective. Then it becomes a business decision, right? Generally, you should never let accounting drive your business decisions, but your business decisions are what they are. At some point, you got to decide, okay, how far do we want to go with the customer? How much do we want to give up before we're ready to let them walk away? And you're going to get some of that from some of your more sophisticated customers. They're going to challenge you on that probably. So be ready for it, and then you be open and how you want to handle those negotiations. Okay, so now I'll talk a little bit about the consequences of falling out of the safe harbor. So from a loan perspective, when you get into the accounting guidance, it says, okay, I did a modification. I'm outside the safe harbor. I go and I apply the regular modification accounting guidance within ASC 310. That's basically what they call a 10% test. So when the present values of the cash flows of the original debt, they cannot differ more than 10% from the present value of the cash flows of the modified debt. So you do that comparison. And the FASB actually just came up with a frequently asked questions on how to do that test, that 10% test, and they did it within the context of on the borrower side, but it's the same test. So you can go in onto the FASB website. You could pick up that frequently asked questions, and it tells you exactly how to do that test. So it was perfect timing for the FASB to come out with that guidance. And that when you do that test, like I said, it takes a lot. You're talking about depending on the structure of the loan, but probably a 500 or 600 basis point increase in the rate, for example, in order to trigger that 10% difference. So there's room there to have those negotiations, and even if you have to change that rate and lower it, you don't have to necessarily worry about failing that 10% test. But the consequences of failing the 10% test are really, if you look at it and say, okay, I failed the 10% test. Now what I have to do is, that's basically telling me that the new loan that I have is not really at fair value. It's at something other than fair value. So then you have to compare the loan that you have to a loan that would be at fair value, and that difference you have to put through the P&L as a day one kind of gain or loss through the P&L. So you have to mark that loan on day one, and then the day two accounting would be amortized cost accounting, and you have to accrete or amortize that premium or discount back into through earnings to get the loan back to par. So you have to basically pull that loan back to par once you move it off of par on day one. So that's basically the consequence of failing that 10% test, is you have kind of a day one P&L entry that eventually gets reversed as you pull that back to par. So that's kind of the thinking as what you have to do if you had to make some changes to loans that fall outside of the kind of the free pass and fall outside of the 10% test. For derivatives and swaps, there's a little bit more involved there. You have to think about whether the change that you made is a change in a critical term. They give you the free pass for a lot of things that are allowed to be changed, but if you make a change to a critical term that's not part of the free pass, then you may have to de-designate that hedging relationship if you have a hedging relationship in place, or the hedging relationship may be ineffective. And then you also have the chance of having some what I call income statement mismatch, because let's say you have a variable rate loan, you do a swap with the customer because the customer wanted a fixed rate, so you do that swap with the customer to kind of put them back into a fixed rate position, but you still want to be in a variable rate position, so you're going to go and enter into a swap with the street that puts you back into that variable rate position that you had. So now you have a loan and two swaps that you're dealing with, and if you make a change to one of those things, and you don't carry that change through evenly across all of them, you could, and even if you're in the free pass zone, you could still end up having some what I call noise in the income statement because of the change may not be exactly the same across all three instruments. So something to think about if you do have those situations with your customers. We got to make sure that we're addressing all the pieces. And if you make that decision that you don't want to make the change in one of the three pieces, that's fine. But at least you know that it's something you need to be thinking about. And there's a possibility that you could have some income statement impacts if you don't kind of follow it through to all the three pieces. So it just gets a little bit more complex there. So the next couple of slides, I just want to talk about what some of the optional expedients are, because I mentioned these optional expedients are out there. What are they, and how does it basically work? So for all of them, the caveat is, if the modification rate relates to the replacement of LIBOR, what does that mean? So for loans, what it means is you get to treat the modification as a minor modification. So that's why you don't have to go and apply the ASC 310 stuff. You just treat it as a minor as long as you're kind of within that list, and then you just kind of move forward. Okay, I make the change, I switch over from LIBOR to SOFR, and all I do is on a variable rate loan, when you make that change, the par doesn't change because the par of the amount of the loan doesn't change. So you don't have to worry about any kind of changes to par values, anything of that nature. You move forward, and all you do is you collect your interest now under the new rate, the SOFR rate, instead of the old LIBOR rate. Once you adopt this practical expedient for the loan contracts, you have to do it for all your loan contracts. You can't do it on the onesie twosie basis for the loan. So once you make that decision to adopt the guidance for loans, then you have to do it for every loan that you make a change to from LIBOR to SOFR, for example. You have to apply the practical expedience to every loan that you do. You have to go across the board. What's interesting about this standard, though, make a note of it, is that there's really no any one implementation date, right? The standard came out in March of 2020. It was effective immediately, but you don't really have to start applying it until you do something for the first time. That's when you really start applying it. So for example, at M&T, while we're working through all this stuff and talking about fallback language and things of that nature, we're actually implementing it for the first time as we have we had to deal with the transition of the discount rate on the derivatives. So we're going to implement it for the first time here as a result of that changeover. So you could do it earlier, you could do it later. It's basically whenever you do something for the first time, that's when you have to officially adopt the standard. But you don't have to adopt, and you don't have to adopt the standard for everything, though. You could adopt it for loans this quarter, you could adopt it for derivatives next quarter, things of that nature, as you make the changes to the contracts that you're making. So it's very flexible from that perspective. Also, which is not on these slides, but there's also a one-time opportunity for debt securities in which you have debt securities that held to maturity. You can get a one-time free pass to move them out of held for maturity to AFS or trading. So take a look at that in the guidance too. It's a free pass they've given you on that. So just a little bit more background on that. I just wanted to share with you. As it relates to your own issued debt, so you may have some variable rate of your own issued debt. In that situation, what the practical expedient does there is it basically says that when you make the change to your own issued debt from LIBOR to SOFR, that change means it's not a substantive difference between the original debt and the modified debt. So you get the free pass in ASC 470. I believe that's where that guidance would be. You have to go to determine whether your new loan or your new issuance is substantially different than the original. Again, this one also, once you do it the first time, you have to apply it to all your individual debt issuances when you make the change from LIBOR to SOFR. You have to apply the practical expedient to that. For leases, the practical expedient that they're allowing there is as long as you're within the modification relates to the LIBOR replacement, you don't have to reassess your classification, and you don't have to reassess your discount rate. So for classification, you don't have to reassess whether it's an operating lease versus a capital lease. You just continue on. If it's an operating lease, you continue on with it as it being an operating lease. You don't have to worry about redoing that classification test. You also don't have to remeasure the lease payments or the lease liability. So that's another nice thing that you don't have to worry about redoing all those calculations. Excuse me. And for this one again, you have to apply it to all the leases that you have. And then the next slide just talks about some of the hedging situations, which I mentioned earlier, is a little bit more in depth in terms of the types of modifications that are out there. For fair value hedges, basically what you're doing there is you're changing the designated benchmark interest rate on your on your swap, and when that happens, so basically the variable leg in the swap switches from LIBOR to SOFR. So when that happens and you have a fair value hedge, what you do now is you say, okay, well, on my hedged item, I get to pick what my benchmark interest rate is. Well, if I have a LIBOR variable rate in my swap, I'll use LIBOR as my benchmark interest rate for my fair value hedge. When you switch on that on the derivative to SOFR, you get a free pass to switch your benchmark interest rate over to SOFR, now it's being your benchmark interest rate instead of the LIBOR swap rate. And then you also get to change the component of the cash flows that you use in the measurement of your hedged item. And you can change that from LIBOR to SOFR as well. For these, though, you could actually do this on an individual hedge by hedge basis. You don't have to do this for all your hedges. You could do it on an individual hedge by hedge basis. So that makes it a little bit easier. It's a little bit more complicated in the criteria, but you could do it on an individual hedge by hedge basis. For cash flow hedges, the rate in the hedge transaction, you get to change that. So if you have a variable rate, let's say you got some variable rate loans that you're hedging, the variable rate in those loans is LIBOR. That's the index that you're used as your hedged risk. When you switch over to SOFR, you change that hedged risk over to SOFR without any problem. You don't have to worry about de-designating your hedge, things of that nature. That's the benefit of the expedient is you don't have to de-designate hedges. You just continue on. You make these changes, and you don't have to de-designate the hedge. You could also change the rate and an option if you're using an option as a hedging instrument. You could change that as well, and you could add out of the money caps and floors as I indicated earlier without any de-designation. Cash flow hedges also you could apply on an individual application basis as well. And then the last one I want to just mention here on the expedience as it relates to kind of derivatives is embedded derivatives. You may have some contracts. You may have assessed them for an embedded derivative, and you may have determined that, oh, I don't have an embedded derivative there. Well, when you make a change over to SOFR and you make a change in that contract, you don't have to go and reassess whether you have an embedded derivative in that contract. Right? You did that once already. Don't have to do it again just because of the change related to the reference rate change. So you just move on those. So that's the basically the ARC guidance, the LIBOR transition guidance, and the associated accounting guidance that I wanted to share with you guys this morning. Before we move on to some of the TDR accounting guidance, and we have another polling question. Okay, so loan contracts that are modified with terms falling outside of the safe harbor guidance provided in ASU 2020-04 would A, require remeasurement or require measurement at fair value, B, require application of the 10% test, C, require an assessment for embedded derivative, and D, require measurement and amortized costs. I'll give you a few minutes. For that. Do we have any other questions at this point, or?
Not right now, we don't.
Okay, great.
All right, I'm going to close the poll in a couple seconds.
Okay. So B was the biggest or most answered, and that's correct. Require application of the 10% test. You wouldn't automatically resort to requiring measurement at fair value. You would do that if you, after applying the 10% test, you fail the 10% test, then you would have to potentially do that, require measurement at fair value. So that you have the intermediate step you would make before you have to jump right to requiring a measurement at that fair value. Okay, so now I just want to turn our attention to, I just want to provide a little bit of guidance on the COVID-19 TDR accounting guidance that's out there. So I'll give you a little background on that. and then talk about the CARES Act, Interagency Guidance, and then some interactions between the two. So there's basically two pieces of COVID accounting guidance that came out. One piece came out in the CARES Act. And the CARES Act, in addition to providing TDR accounting guidance, it also provided some additional guidance related to accounting and banking. It created a forbearance program for federally backed mortgage loans, protects borrowers from negative credit reporting. As it provided the option to suspend TDR accounting, and it provided a one-year exemption from applying CECL guidance. So the CARES Act was a little bit more broad in its scope compared to the interagency guidance, which was the second piece of guidance that came out. The interagency guidance basically came out as an interpretation of the TDR accounting guidance on the U.S. GAAP, and it really focused on loans by suspending past due reporting and provided some guidance on how to handle non-accrual designations and reporting. As it relates to the CARES Act, the CARES Act provided some more flexibility around the TDR requirements. It allows for, in terms of exemption from TDR, or actually allows you to suspend TDR accounting, which is different than the interagency guidance, which just did an interpretation of that. So that's the distinction there. But basically, within the suspension of TDR accounting under the CARES Act, you could do more things. You could have forbearance agreements. You could do interest rate modifications, which is a big one that wouldn't fall within the interagency guidance. You could do principal and interest waivers in addition to principal and interest deferrals. So waivers was another big one that was not basically allowed under the interagency guidance. You could do some fee waivers, you could do covenant waivers, and you could do extension of repayment terms. The CARES Act allowed for the suspension of TDR guidance from March 1st until December 31st, or 60 days after the date of the emergency terminates, the earlier of those two. So now we're at the 12/31 date because the emergency hasn't been terminated yet. So it looks like that's going to expire on 12/31 in terms of application of the CARES Act. For the interagency guidance, the interagency guidance was an interpretation of the TDR guidance in ASC 310-40. It was also done in conjunction with the FASB. And basically what that guidance did is it took the insignificant guidance in the TDR aspect, or the insignificant aspects of the TDR guidance, and said instead of the insignificant guidance relating to a 3-month term, it relates to a 6-month term. So if you wanted to do a 3-month extension or a 3-month principal and interest deferral under current GAAP, that's okay. It wouldn't be a TDR because it'd be considered insignificant. What this guidance did is it said, okay, let's say now we're going to expand it to 6 months. Now you could do a 6-month principal and interest deferral, or you could do a 6-month extension of the terms and still be considered insignificant. So that part of it, a lot of the modifications that were done as part of the COVID mods were extensions and deferrals. So, and they were done for 6 months because everyone thought it was going to be a short-term situation. Basically, application of the TDR guidance under the CARES Act versus interagency didn't really matter for that first go around, but it matters a little bit for the second go around, where now the first go around you may have 6 months worth of extensions or deferrals going from March and ending in September, October. Now that the second round is coming along and people are asking for a second round of deferrals and extensions, the CARES Act would accommodate that, but the interagency guidance would not, because the interagency guidance is basically capped at 6 months, at a 6-month term. So when you look at comparing the interagency guidance to the CARES Act, the CARES Act has that December 31, December 31, that should be 2019, not 2119. Sorry about that. That's a typo. The CARES Act has a December 31, 2019 date that you use to determine whether the loan was current. So there's criteria that say the loan has to be current as of a certain date. It must be COVID mod related, and it must be within a certain time period, right? So the CARES Act uses 12/31/19 as the current date, so he can't be more than 30 days past due at 12/31/19. CARES Act relates to all modifications, and the time period is March 1 to December 31. For the interagency guidance, you had to be current as of the date in which you implemented the program. It was basically limited to interest rate modifications and principal and interest waivers. So interest rate modifications and principal and interest waivers were not permitted. It was related to basically deferrals and extensions, so a little bit different there. But there was no time period in which you could do it. You could do it now if you want to, but you're limited to 6 months. So there's these differences between the two. The good thing about it is you can elect either one. You could choose between either one you want to do, which is nice, and then so you pick the one that works best for you. So if you pick the interagency for the first round of modifications, for example, and you get to determine, say, I did the 6-month deferral, I want to do another 6-month deferral, but you can't do the interagency guidance because the interagency guidance says you can't do another 6 months. But I could apply the CARES Act, and as long as I get the modification basically booked, the additional 6 months booked by December 31, even though it goes into 2021, that's okay. I could apply the CARES Act and not have to report the modification as a TDR. Even though you don't have to report it as a TDR under the CARES Act, one of the things that the agencies came out and said is that, okay, that's great that you're going to get the CARES Act exemption from TDR, but exemption from TDR does not mean exemption from non-accrual status. So you have to still consider your loans from a credit risk perspective. It's very important, and they've stressed this, that you got to consider loans, whether they should be appropriately credit risk rated, they have to be appropriately reserved for, and the non-accrual status has to be appropriate for those, regardless of whether you're going to apply a TDR exemption or not. So the agencies are making that very clear that TDR exemption does not give you exemption to the other things. I just wanted to kind of stress that here as well. So that's the kind of a quick update on the TDR accounting guidance as it relates to exemptions. And we'll have one more poll question, and then I think I have just one quick slide on PPP loans, and that should bring us to the end. I know we're going a couple minutes over, but I think we'll be finished up by about 10:05 or so, if we're okay with that. So last question: when applied, which of the following results in suspension of U.S. TDR guidance? Application of the CARES Act, application of the interagency guidance, neither result in the suspension, or both result in the suspension? Give you a few minutes on that, or a minute or so on that. Do you have any more questions that have come in?
Yep. Again, this is going back to, it seems like an exercise to reassess projected interest income given all these potential interest rate changes is warranted. Are people doing that at a high level?
Going back to the
LIBOR, yeah. Yep.
LIBOR, okay. Read it one more time for me, please.
It seems like an exercise to reassess projected interest income, given all these potential interest rate changes, is warranted. Are people doing that at a high level?
That's a good question. No, I don't know. I don't have, unfortunately, I don't have an answer for that question. I don't know if people are thinking it as a high level or as an individual loan. Now, I would have to think, I'm part of the accounting group, not part of our treasury group.
Right.
So I would have to think our treasury group is looking at this holistically and saying, okay, what's going to be the impact to the bank for transferring our portfolio of loans from LIBOR to SOFR? What's going to be the impact of that? Now I would think that the fact that the rates are going to be equivalent, you're going to go from a LIBOR rate to a SOFR plus rate. So maybe like as I indicated earlier, maybe the SOFR plus 25 basis points is the equivalent to the LIBOR today. So when I go and implement that, you would think there would not be as much of a change in the overall interest that you're expecting as an organization, through a certain period of time. But the fact that spread right now on SOFR is a fixed spread and LIBOR is not fixed, there could be some implications of that to your overall, interest income collections over the course of time. And that's one of the reasons why they're looking to come up with a kind of more of a variable spread on SOFR that would be more dynamic. And hopefully that'll come into play by 2023 when things are getting pushed out to. So that's a good question. I would have to think that our Treasury Department is doing that. And that's something I think, as an organization, you'd want to make sure that, the appropriate folks are looking at that. So very good question.
Thank you.
Yep. Okay, so the last slide I have here, I just wanted to give a quick slide on the PPP loans that came out of the SBA. And the points I wanted to make here were that they are loans and they're not grants. There was some question about, well, maybe these are grants because the SBA is actually, forgiving some of these things. But the accounting guidance came out that they are loans, they're not grants, and they'd be accounted for under ASC 310. Any fees you get associated with them, because there are some loan fees that you get on those, they would be deferred and amortized, same way you do any other loan fees. And that the guarantee that comes along with it from the SBA is part of the loan, so that if you're under CECL, a zero CECL reserve would be okay for the principal on these loans. But you may need to think about setting up some reserve for the accrued interest receivable if that accrued interest receivable may not be payable from the SBA. So those are just a couple quick points just to think about on the PPP loans. I just wanted to put that slide in there for educational purposes. So that's all I have for today. I appreciate your attention and hopefully some good information here for you to take back. And I think, as I indicated, if you get an opportunity to go to the ARC website and take a look at all the good materials they have there, I think it's a very, very helpful website.
Great. Thank you so much, Kevin. As with all sessions, participants will receive a copy of the presentation, webinar recording, and a brief survey via email. Please look out for those materials early next week. We welcome your feedback on this seminar series. You can also reach out to Kevin directly with any additional questions that you may have. At this time, I'd like to introduce from the Bonadeo Group, Paul Fries and Aaron Kofira, both partners in our financial institutions group, as well as Nate Penskin, who's a principal in our financial institutions group, for a year-end financial reporting update. Aaron will begin with the accounting update, and then Paul and Nate will conclude with the year-end tax update.
Thanks, Jamie. As Jamie indicated, I'm Aaron Kofira. I'm going to be covering the financial institutions, the accounting side of the house. Then we'll turn it over to Nate and Paul to cover the tax items. As many of you probably are aware of this, I make no reference to know anything about taxes, so I definitely will leave that to the individual experts. This is my overall bio. I assist Jamie and as well as many of the partners in the financial institutions team in performing the second partner review on a lot of the financial institutions that we do, as well as do a lot of the overall accounting analysis and guidance for the individual teams. So I think to kind of kick off, some of this information has been out for a little bit of time, but I think it's important to cover to make sure that everybody is aware of it. And given that the amount of information overload that we've received probably within the last 5 or 6 months with the current situation, pandemic that we're going through. Before I jump into the slides, the one thing I will note from a COVID perspective, that's not really in one of these slides. It's not really new information, but something to be thinking about at your financial institutions is there may have been an asset impairment trigger that occurred as a result of COVID back in March. And so you may have to be considering your goodwill and potentially your mortgaging servicing rights in conjunction with COVID-19 as part of this upcoming year-end accounting cycle that we're currently in. There's not really a slide on that per se, but I think it would be remiss of me not to at least mention that as part of my opening comments from a high-level non-financial institution type items. With that, I will segue into the overall accounting update, if you will, and kind of walk through some pronouncements as they pertain to the financial institutions in general. The good news is you're not going to hear me talk a lot today because there's not a lot of new topics that are covered. So a lot of the things that we may touch upon either will have a minimal impact or are being deferred out for a year or two and potentially will not have a significant impact even when they do come into play down the road. So that's some good news for everybody on this call, as well as for everyone with everything that we're dealing with, to not have to deal with a lot of new heavy techie accounting guidance. That is definitely a good thing. I can't say that's the same from the tax side of the house, but I can definitely say that from the accounting side. The one interesting thing that came out, this FASB update kind of came out in April, and it really was not an ASU, it wasn't an ASC, it really is, and technically it's deemed to be non-authoritative in the world of GAAP. And it really looks at how are you accounting for these loan modifications and the actual interest that you're receiving as part of that's would normally be recorded, and now that the loan has been deferred, what do you do with that overall interest? And so there's two different views on it. This is obviously view one, is that you would just continue to record interest over that deferral period, and as if nothing really happened. You just continue to record interest and you collect it down the road. And that was one school of thought. The second school of thought is you wouldn't recognize anything in that overall period of time. You would just continue, you'd stop. Because the loan's been deferred, you'd stop recording any interest on it. And then once it comes back up and comes back online, you'd go ahead and begin to record interest at that point in time. And so the technical inquiry came into the FASB saying, hey, what's the right answer in the sense of with the overall treatment of these loans? And surprisingly, the conclusion really is either method is appropriate. So there really was no they didn't really bless one method or the other. They did say you need to be consistent with regards to all your loans. You can't pick and choose for certain loans. I'm going to take the interest and over the holiday period, and then the other one I'm not going to do it. I'm going to defer it. You have to be consistent across your entire portfolio. The important thing here is to note that it does need to be disclosed within the financial statements with regards to your overall policy. Now, to give you some insight as to what we're seeing in practice and have seen in practice with a lot of our financial institutions, we have seen that for the majority of them, they've continued to record interest during that overall deferral period for what that's worth. That's kind of what we're seeing within our practice. Also, now shifting away from the FASB, the AICPA actually put out some technical Q&As. These are also non-authoritative items in conjunction with the PPP loans. And I know that Kevin did touch upon these as part of his presentation. This is kind of the quote unquote techie section of where what he had talked about was kind of included. And I think so I'll run through these four again relatively quickly versus having to go through the topic again. The first one, the termination of the effective interest rate, that's really what we just talked about in the AICPA republishing the FASB's guidance on these loan deferral periods. The second one, the classification of advances, again, they're a loan. You should be treating them and accounting for them as a loan, not a grant. The guarantee is a embedded derivative not an embedded derivative, it's embedded as part of that loan, and therefore when you're going through the CECL model, or for that matter, for any of these, the accounting is the same either under the current model or the CECL model. You would just consider it as part of that loan. And then for the origination fees for the clawback, you would just continue to go through and amortize those over the life of the loan. The one thing of interest and of note here with regards to that is a lot of times there may be, the loan may be forgiven or sooner than later, and so it might not hit the full term of the original the loan. And ultimately, financial institutions are going to need to go through and analyze the overall MSRs, or I'm apologizing, wrong wording. The loan origination fee as part of that analysis at year end to ensure that it still is appropriate to be included on the overall books. So from that perspective, I'm going to pause for that's kind of the FASB and AICPA update. Like I said, the good thing is there's not a lot going on, and we'll talk about some of the other ASUs that are actually coming in. Right now, we're going to go ahead and launch a polling question, and the question is this: is your financial institution, A, are you an SEC registrant? B, you're not currently an SEC registrant, however, you're thinking about going public or in the process of going public. Or C, you're currently not registered, not interested in going public, don't want anything to do with going public. And that's kind of the question that we're kind of asked, because I'm going to kind of go through one of the items that if you do see any SEC registrant clients or are an SEC registrant, there may be some changes to your audit reports that I think it's important that you're at least aware of as to what that's going to look in case you get questions from your stakeholders or your audit committees, just so that you have a overall general sense as to what that is and what these new critical audit matters, or CAMs as they're more commonly known, really are. So I don't know if once the poll closes, I'll be able to get a sense as to where we're shaking out with that. Okay, so the majority of everybody on this call, which is no surprise having seen the listing as to where we are not in the interest of going public, or are not public at this point in time. So with that, I am going to kind of I will glaze over this a little bit to a certain extent and kind of hit kind of the highlights on what a critical audit matter is. It's important to note that these critical audit matters are not applicable to let's say non-public companies or normal AICPA type audit reports. So if you're not a registered entity, or if you are not a SEC bank, you're not going to see any changes in your audit reports for these critical audit matters in the current year. That's not going to happen. This is only for public entities, and you may have seen these for large accelerated filers already if you look at any of their 11 or 10K engagements, because they are already coming into play for them. So this is really impacting the smaller entities or smaller PBs that aren't defined as a larger accelerated filer in the current years. Good thing also to note here for some of our client base that is a SEC registrant, you maybe have elected the emerging growth companies status. They would not be required for you as part of your overall audits. Also, if you have an 11K engagement, you do not have to worry about these critical audit matters. And really, at the heart of these, what these critical audit matters really are is they have to hit two criteria from an auditor perspective. And this is, again, the PCAOB driving what should be reported in the auditor's report. So the only place it's going to really show up is in the auditor's report and the auditor's language on this. And it has to hit two criteria. It's got to be a material disclosure or account in the financial statements. And it also has to involve a lot of subjective and challenging ways of auditing. It has to be difficult. Let's put difficult in quotes to audit it. And really, this is a very subjective item and subjective matter. So I could see, and this is just me, this is my little disclaimer at the beginning of this presentation kind of kicks in. I can see a lot of accounting firms being criticized for maybe not selecting certain critical audit matters that maybe the PCAOB does think should be when they come in and do inspections on individual audits that are being performed. So the jury's still out on that, but I think a lot of the concern with these critical audit matters at the time was that they're really going to be, auditing firms are really going to be criticized for not identifying certain ones and identifying other ones, and really it's going to be very difficult for accounting firms to, I don't want to say get it right, but they're always going to be open to criticism from the PCAOB, the regulator that oversees the public company account audit, if you will. As part of these CAMs included in the auditor's report, there's going to be basically 4 things that have to be covered for any of them that you look at. And this would be for if you looked at a manufacturing entity or a financial institution. And we'll kind of talk about, you probably have a sense already in your mind as to what these probably would be or what they would look like when you're going through and evaluating your own financial statements. If you were a public entity, you kind of know right out of the gate. I bet it's 1, 2, 3, or 4 things that I don't want to steal my next slide, so I'm going to hold off on telling you what we've seen so far. You have to identify it. You have to talk about what led you to think that it was difficult or led you to believe that it's a challenging area to audit. A description of how you addressed those difficulties in the auditing of those items. And then basically you would just reference where in the footnotes those items are captured from a disclosure and reporting perspective. Early results are in, and as expected, where are we seeing the overall CAMs and matters identified in the auditor's report? Well, they're really around loan loss, right? I mean, that makes sense from a financial institution. That's where a lot of the risk is. Fair value of investments, oftentimes we see that not necessarily within our portfolio and within upstate New York, it's not really a lot of fair value of investments in hard to value items. And generally it's normal municipals and normal held to maturity debt, but there may be some derivatives out there that are difficult to value, as well as sometimes the deferred taxes are challenging, and then obviously the fair valuing of certain residential service mortgaging servicing rights are often included in the auditor's report. This is an example of one that is for Key Corp, which is a pretty large bank, as everybody's aware. You have a description of the matter on this slide. It kind of talks through what is it, the loan loss is important, and here's the individual references, note 1 and note 5 in this instance, of that specific matter and where those items can be reviewed from a review or an analysis from a shareholder perspective. Also, within this CAM, they talk about how they addressed it. They obviously looked at some of the internal control processes that are in place because it is an integrated audit for Key Corp that's performed by their auditors. And then also, as part of the analysis, they talk about the qualitative factors, which obviously everybody on this call is aware. Qualitative factors are something that their auditors definitely focus and spend a lot of time looking in and analyzing. So that's kind of the overall CAM for like a loan loss one here. This is more informational than anything else. This is one, it follows the same exact format. It's a different auditor. It's with PwC, but it's following the same kind of format in this sense. This is for financial instruments that are valued at a level 3. It talks about the amount. It talks about the leveling of it. What's the difficult considerations that caused the auditor to pause on it, how they went through and addressed it. And then ultimately it kind of just says that's it. That's from a CAM perspective, that's what they did, and that's how they went through and looked at it from an audit perspective to gain comfort over it. So with that, I'm going to just pause on that real quick and now shift over to talk about some of the ASUs that are currently out there. And I think the good news is that I'm going to actually be sharing good news for a change. Generally on these sessions, I bombard everybody with all this stuff that we have to do, and it's a kind of a bummer because I look like a bad guy. Good news is this year I'm not. I'm actually a hero. So I'm going to start off by saying the deferral of the lease standard has been kicked down the road till calendar year 2022. So that is a good thing. If you have a significant lease portfolio, you have a little bit more time if you are not a public company. Obviously, if you're a public company or have adopted it already, you will not be able to take advantage of this. But for a lot of the normal traditional banks and credit unions on the call, you get another couple years to have to worry about it. ASU 1708 is not really anything that's really controversial from an accounting perspective. It is applicable as part of this year end that is upon us. It has not been deferred, so this one is applicable. It's for any debt that has been purchased and has a call feature on it. And really what it does is what the first bullet says. It shortens the amortization period to the first callable debt period for amortizing that premium. So if you have a premium that you have been amortizing it, and you've been amortizing it over the life of that debt, well, actually under this new ASU, you would now take it to that first individual callable security date for that security. So there might be a little bit of analysis that has to be done for any debt securities that you have that are being held, that are being carried at a premium. You would now be taking that premium over the shortest period of time. For this one, this is good. I know that Kevin covered most of the stuff in this section of the ASU. Just wanted to make sure that we've got it in here and that ASU 2020-04 is applicable, and Kevin went through this, so I'm not going to spend a lot of time talking about it. I will pause on here because he did mention there's that held to maturity debt securities, that one-time transfer that is allowed. That is also here referenced for your information as well. One elimination of disclosures, which I know is another surprise, but for other than public business entities. So if you are not a public bank, you are able to actually eliminate the presentation of the unrealized gains and losses within the footnote of that table for held to maturity securities only. Now, this is held to maturities, and it's only for non-public entities. So if you are SEC or in the process of registering SEC, this isn't going to help you, right? But you can, if you're not, if it's just a normal traditional financial institution, including credit unions, and you have held to maturity dates, held to maturity securities, you now only have to show them for the amortized cost value. You do not have to look and show in that table where you would start out. You got your amortized cost over here. You definitely see on the available for sale securities. You start here. You have your gross unrealized gains, and then you have a gross unrealized losses. And then you get to the fair value number. Well, for held to maturities, that is no longer a necessary disclosure. You do not need to show those unrealized gains and losses as a result. So a surprise, some additional good news, because again, we're getting rid of some disclosures. For improvements to non-employee share-based payment accounting, this is a relatively easy ASU. If you grant options or any other sort of like warrants or anything to non-employees, so consultants or somebody along those lines, you will account for those individual options and grants and warrants and everything just like you would as if the individual is an employee. This basically just cleaned up the accounting and said, you know what, it's too difficult for people or practitioners when preparing financial statements to try and have to apply two sets of standards for share-based compensation. Let's just make it all one. So now all the rules are all in one spot. So it definitely makes life a lot easier if you have that. So it's time for poll question number 6, which will be popping up momentarily here. Okay. Where does your financial institution stand in the CECL implementation phase? What is CECL? You formed a committee to discuss, or you already have a system in place and are running models. Okay, so the good news here, I have no idea what CECL means. So I did A. So if you're curious on that, I do that tongue in cheek. I will encourage you to continue to monitor the financial institutions newsletter that we put out. As we move closer to the CECL implementation, we will continue to develop white papers, continue to provide guidance, and hopefully soon we'll be able to resurrect our CECL roundtables that we were having prior to the pandemic. It was always nice to get out and see everybody. So hopefully within the next year or so, we'll be able to restart that. But I definitely encourage you to go through and just keep an eye on any sort of guidance that may be forthcoming from us, as well as the world out there. There's a lot of definitely information from a CECL perspective. So the bulk of everybody, they have 23 individuals have indicated that there's been a committee that has been formed And generally, that's what we're seeing is that we've got a committee. We're starting to talk about it within our financial institutions. Maybe we don't have a system. Certain entities do have systems running it already. 12 of the respondents do already have that, so that's great to hear. From an accounting perspective, I think it's definitely, even though we do have a little bit more time now, I think it's important that we don't let our foot off the gas and continue to move forward on those overall efforts. A couple new CECL ASUs that are out there that are coming into effect are really 1904, which talks about accrued interest, and really what that does is it allows you under the CECL model, to make a policy election and to present that CECL for the accrued interest as either part of that asset or separate. You would just need to include how you're accounting for it, if you're including it as separately or as part of the overall accrued interest line item on your overall financial statements. 1904 also talked about the transfer between categories for loan and debt securities. So if you have securities that are moving around, what happens is when they move from one CECL model to another, there may be differences in how you account for them. And ultimately, 1904 said when you do that, you would just reverse any sort of CECL reserve that has been accrued into earnings, and then you would just evaluate it under the new model. So theoretically, the net of that is going to show up in your financial statements when you do make that impact. The last item under 1904 is with regards to recoveries. As you're going through your CECL modeling, if in the past you have received recoveries of, let's say, $1 million on your portfolio, and you're expecting that under CECL you're going to get recoveries of $1.3 million, guess what? You're only going to be able to show a $1 million recovery under this. You can't use what you're projecting out. You need to use what you've actually received as part of the CECL calculation. The last thing is 1905, the fair value election model. I think this allows you to go to a fair value model for a lot of different financial instruments. However, unfortunately, or fortunately, depending on how you look at it, it is not applicable to held to maturity debt securities. So if you have any of those, you cannot elect a fair value option and start marking that in the market. It's not allowed under current GAAP as a result of 1905. So with that, I'm going to go ahead and turn it over to Paul and Nate to take us through the overall tax update. Guys, I'm going to transfer it over to the conference room. I think if I can do that. Let's see here. It's been done, Nate. I think you guys are up.
All right. All right, thanks, Aaron. Paul Freeze and Nate Pension here, representing the tax side of Bondio's Financial Institutions team. And we'll take you through the last half hour of the presentation with the year-end tax update. The 2020 year-end tax planning, I would say, is difficult at best, if not impossible. How can you compare current year versus following year when you don't know what the rule book's going to look like in the future? There's so much uncertainty, primarily around a potential tax rate increase for corporations under the Biden proposals. And there, in the past 2 or 3 years, January of 18, we started with the Tax Cuts and Jobs Act, and that's changed the tax structure, comprehensively. And then now that we're getting our hands around that, the end of 19 and into 20, we saw the Secure Act, we saw the Coronavirus Families First Act, we saw the CARES Act, which was passed in March 27th of 2020, and had provisions that related back to January of 18. So not only are you trying to compare where are we currently versus where are we going to be, you're also now going and looking backwards and figuring out, well, now I've got opportunities to amend or adjust my 2018-19 numbers. So we're moving in all different directions. So it's difficult to get your hands around. Do you have the slides?
I'm trying to pull them up.
We're having some technical difficulties pulling up the slides. In any event, we're going to start. We're going to do an overview of current year federal tax provisions, and then there we go. And then secondly, we're going to move on to COVID-19 related provisions. There's been a lot of merger and acquisition activity recently, so we're going to touch on that. State tax nexus. States have been becoming more aggressive over the past half a dozen years, trying to pull in new taxpayers under economic nexus requirements. I would have to imagine that trend's going to accelerate given the fact that so many states are looking for tax revenue that's significantly reduced with all the shutdowns. And then we'll finish up with, where do we think Biden proposals are going to move us. So with that, we'll let Nate's going to start and go over some of the federal tax provisions, starting with just kind of a recap of some of the permanent tax items from the Tax Cuts and Jobs Act. All these items will affect your effective tax rates. We just want to review them as a basis for comparing and contrasting.
All right, thanks, Paul. As Paul mentioned, over the last 3 years, we've seen two significant rounds of tax law changes. So I think it's important for us to see where we currently stand in terms of tax law as a comparison to where things could potentially go under a Biden administration. So currently, corporate tax rates stand at 21%. This is the lowest the rates have been in a number of years, and it puts the U.S. more on par with other countries around the world. Dividend received deduction is 65% for any 20 to 80% owned affiliates, and 50% for any less than 20% owned affiliates. And on this slide, the big takeaway that we want to point out is in regards to net operating losses. Under the CARES Act, significant changes were made. While our financial institutions have generally remained profitable, a number of our other clients have been significantly impacted by the downturn in the economy as part of the pandemic. So to help alleviate and get cash back into the pockets of these taxpayers, Congress, under the CARES Act, now allows a 5-year carryback for NOLs that are incurred in tax years 2018 to 2020. And the significant point here is, the tax rate's currently at 21%. These NOLs can be carried back to tax years 2013 to 2017, where tax rates were as high as 34%. So not only can companies get cash back into their pockets fairly quickly, they're also going to recognize a potential 13% permanent tax savings. And the important point that we want to point out is there is a window of time to do this. It's only for tax years 2018 to 2020. Starting in 2021 and forward, the NOL rules revert back to what they were under the Tax Cuts and Jobs Act, meaning there is no carryback period permitted, and instead there is an unlimited carry-forward period. In terms of disallowed expenses, there really hasn't been much of a change between the Tax Cuts and Jobs Act and the CARES Act. M&E entertainment-related expenses are still 100% non-deductible, whereas meals are 50% deductible. And any social activities, primarily for the benefit of employees, meaning holiday parties, outings, these expenses are potentially 100% deductible. In terms of transportation fringe benefits, what the IRS was trying to do under the Tax Cuts and Jobs Act is state that there is a benefit to employers providing free parking to their employees, and because of that, this benefit either needs to be included in the W-2 of the employee, which almost never happens, or the company or the financial institution would need to include these fringe benefits as taxable income on their corporate return. we really haven't seen much of an impact to our financial institutions, mainly because there's a couple safe harbors that the IRS allows. First is if a parking lot's used for if the parking lot spaces are used 50% or more by customers, then there is no add back that's necessary. And so, for financial institutions with branches, most of these branches are primarily used for customers. There is also a geographic grouping allowed, a safe harbor allowed, that is beneficial to our financial institutions. For instance, if a bank has a couple branches in Rochester, one of which the spaces are used less than 50% for employees, but there's a couple other ones that are used more than 50% for customers, the financial institutions can group these branches and take advantage of the safe harbor. So again, we haven't seen much of an impact in regards to transportation fringe benefits on our financial institutions.
Nate, one other permanent difference I was thinking about, now that the banks have substantially increased their deposit balances, I know they're looking for investments with better yields, and not sure whether they're now looking to invest more in non-bank qualified munis, but to the extent that you are, then the interest allowance is going to be higher than on bank qualified munis. So that's another item that could potentially, if you're changing your investments in municipal bonds to non-bank qualified munis, that's another book tax difference that's going to potentially impact your year-end effective tax rate.
That's a good point, Paul. Thank you. In terms of cost recovery, takeaway here is there really has not been much in the way of change between the Tax Cuts and Jobs Act and the CARES Act. Bonus depreciation is still available at 100% for eligible assets, both new and used assets. And starting in 2023, bonus depreciation is going to be phased out by 20% each year, and it will be completely phased out by 2027. 179 for 2020, there is a $1,040,000 deduction for eligible expenses, assuming the financial institution has not placed more than $2,590,000 of assets into service. Section 179 can be used on tangible personal property as well as residential property. Also roofs, HVAC systems, fire protection alarm systems. Longer lived assets, still 179 can be used, which is important because with these longer lived assets, it would take a significant amount of time to otherwise depreciate them. And qualified approved property, or QIP, is also eligible for 179. We are on to our first polling question. When does bonus depreciation completely phase out? 2021, 2030, 2024, or 2027? We'll leave that up for a minute. All right, moving on. So one significant area of cost recovery that has changed as part of the CARES Act passage is QIP. Under the Tax Cuts and Jobs Act, QIP was 39-year property and therefore not eligible for bonus. So now the key takeaway here is QIP is now 15-year property eligible for 100% bonus depreciation, and this is retroactive to tax years beginning 1/1/18. So what we've been advising our clients is take a look at your fixed asset records going back to 2018, 19, and 20 for any 39-year property that may be QIP eligible, and therefore we can accelerate a significant amount of deductions potentially. And there's two ways to do this. There's two ways to report this change in QIP, one of which is to amend your 2018 or 2019 tax returns, and the other is to file a Form 3115 change in accounting method and attach it to your 2020 returns.
And just as I said in the introduction here, again, not only is your year-end tax planning, are you considering 20 versus 21 and moving forward, here's an opportunity to look backwards. For example, let's say in your 2018 return, you had significant pension plan payments, defined benefit plan payments, and your taxable income was relatively low. Well, in that year, you had to put your QIP assets on and as 39-year property. Well, now if you can look at it and say, well, wait a second, I can move them down to 15-year, take 100% bonus. Does that drive me into an NOL position, which I can then, again, carry back to the 2013 tax year and use 21% deductions to refund 34% tax. Or, you can throw it on the 2020 return and potentially say, well, I can make, significant pension plan adjustments now, and depending on where your taxable income is, drive that number down and carry that back 5 years. So again, if you take nothing else away from this presentation is, you kind of have to have your head in a swivel because you're looking in all directions right now on trying to piece all these provisions together. Alrighty, moving on to COVID-19 related provisions. For PPP loans, when there's forgiveness, normally banks will be required to issue forms 1099-C to the borrowers. Those will not be required. So there's a good answer. For purposes of your borrowers, the IRS position is that expenses paid with PPP forgiven loan income will not be deductible. So, essentially, most of our clients and your clients look at this as, hey, I got PPP loan money, it's going to be forgiven, I paid salaries with it, so therefore it's an expense on my P&L and therefore it's deductible. If that's your mindset, you basically have to consider the fact that, the forgiveness will be taxable to them. So, bottom line, you have to get to net zero for the IRS position. The question is, will Congress pass legislation to reverse this position because they originally sold it as the forgiven loans will not be taxable income. So, right now the IRS position was originally issued by an IRS notice, which is relatively low on the hierarchy of authority. That has now been updated with a revenue ruling, which is much higher on the hierarchy of authority. So even though it appears that the intent of Congress was to make it non-taxable, as we sit here today, if you want to try to take a position, if your borrowers want to try to take a position on their returns that they can deduct these expenses in 2020, then they'll probably require some kind of disclosure on their returns. Getting back to the bank side of things, the processing fees that the banks earned for the PPP loans. Again, the financial statement treatment is to defer and take the income over the life of the loan. If I'm understanding correctly, a lot of these are 2-year loans or maybe up to 5-year loans. So, at least as I approach 12/31, that's kind of the thought process I have in my head. For tax purposes, to the extent this would be deemed to be akin to interest, it would follow the financial statement treatment. But, most of the commentators out there, it seems almost certain that these are deemed, the fees are going to be deemed fees for services, which are required to be recognized at the earlier of receipt of cash or financial statement recognition. So, for all intents and purposes, we're operating under the thought process that these items, these fees will be recorded as 2020 taxable income. From a positive side, we know that that'll get 21% treatment. From a negative side, again, if you're trying to create a 2020 NOL so you can carry it back, then this additional taxable income is not helping you in that vein. Next slide. Loan modification.
We have had some questions roll in the chat, okay?
Sure.
So as it relates to forgiveness, one of the participants pointed out that there is no reason to wait until 2021 to request forgiveness. Could you please address that?
Yes. Again, the way the law is written is the forgiveness of PPP loans will not be taxable, but general code concepts and provisions state that if you use non-taxable money to pay expenses, then those expenses are non-deductible. So again, I say the books of the world have to be in balance. If you receive cash and it's non-taxable and use that cash to pay expenses, well then they're non-deductible. You have to get to a net zero. So then the question becomes, it's the thing called the all events test. When are all the events certain and in place when you file your return to determine whether or not you're entitled to a deduction? Well, again, to the extent that your borrowers are fairly certain that they're going to get the loan forgiven, and they can estimate that amount, then that amount of expenses should not be deductible. Well, when are all the events set to determine whether those expenses are non-deductible? Well, those are all salaries paid in 2020. So again, there's differences between cash basis and accrual basis taxpayers, but as a generalization, to the extent the borrower knows by let's say for argument's sake, and I am choosing my words carefully because there will be room to address these issues client by client. But by the time in general, by the time the borrower files his 2020 tax return, if he knows he's going to be forgiven $100, then essentially $100 of his 2020 expenses will be non-deductible. Hopefully that answers that question.
Okay, thank you. Then we had another one. This one I'll respond to. Do we need to net out expenses associated with the origination of the PPP loans and defer the balances as with other FAS 91 loan origination fees and costs? Yes, that is correct. The loan origination fees and costs associated with PPP loans are accounted for in accordance with ASC 31020, and yes, they would be deferred consistent with the fees that you incur or that you recognize associated with the origination of those loans. Okay, we're good now.
All right, super. Second item is loan modifications. Most banks that I'm aware of have not deferred interest accrual, even though the principal amounts have been deferred for 3 months or 6 months or whatever. So general tax law is to the extent you're you have a contractual right to the revenue, then you're supposed to continue to accrue interest. So for banks that have discontinued, have modified the loan agreement to defer both interest and principal, you should definitely talk with your tax providers, make sure we're on top of that. But again, it's my general understanding that most banks have not discontinued the accrual of interest. The second concept for tax purposes is a significant modification of a debt instrument. So if principal deferrals last long enough, then is there the potential that there's a significant modification of a debt instrument for tax purposes? The general thought process here is that the deferrals of 3 or 6 months are going to be immaterial enough so as not to trigger that. And if you want to take a step back, even if those are triggered, the modification of the debt instrument usually has more negative implications to the borrower because they're receiving some kind of relief. and any potential income in that modification would be on the borrower side, not on the bank side. But again, all things that need to be discussed with your tax professionals.
Paul, we had another question come in. Could you discuss again the treatment for banks, the treatment of the processing fees received for PPP notes? All banks received the cash in 2020, but for the financial statement purposes, they're being recognized over the 2-year period. This is a temporary difference, correct? You're not
Correct.
being taxed in 2020 on the full cash receipt.
You're deferring it for financial reporting purposes, and in general, yes, you will be taxed fully on the cash received on your 2020 tax return, but it is a timing difference. Did I understand that question correctly,
Yes,
Jamie?
thank you. Yes.
The last two items I want to hit are payroll tax credits. Now these will, if you're taking advantage of these, they are running through your payroll tax returns. Both will require some kind of adjustment on your income tax return. So if you're involved in either one of these programs, again, when you're pulling together your year-end provision, we're going to need to be on top of this. The first one's the employee retention credit. Essentially, this is a 50% credit on qualified wages paid between March and December. It's a quarter-by-quarter test. The maximum eligible wages for purposes of the calculation are an annual amount of $10,000. So for argument's sake, you'd say $2,500 a quarter. So it's for businesses that have not taken PPP loans, and for businesses that experience a full or partial suspension of business due to government order or decline of 50% or more of your gross receipts quarter over quarter compared to 19. So the big question was, do banks qualify? And now again, state by state, things would be different, I'm sure, but for the most part, banks were deemed an essential business, and for most of the states around here, we're not required to close. Well, a number of banks said, well, for all intents and purposes, we had to shut our branch lobbies down. Well, you were not required to, but effectively, was that the result? So I do know that a number of businesses were going around and I'll call it peddling this participation in this to various banks, and I'm not aware that a lot of banks have taken advantage or pursuing this, but I am aware of some. And my word to the wise is, your facts and circumstances have to be evaluated by each institution, and to speak with your tax professionals as we roll into year-end provisions. Not saying that banks don't qualify. I'm saying we got to look at all the hurdles. Next one, Nate. Nope, poll question. You lost that. So a business can apply for the employee retention credit if they have received a PPP loan. True or false? And we'll give you a minute to answer that. Okay, a couple more seconds, and then we'll close the poll. The correct answer, most everyone got that, is false. Again, that's one of the stipulations preventing participation in the employee retention credit was receiving PPP loan proceeds. The other payroll tax credit I just want to touch on was the Families First credit. It's for employers with 500 and fewer employees, and there were qualified sick leave wages or qualified family leave wages were the two criteria. And essentially, it's for payments to employees who were sick with COVID or whose family members were sick with COVID and therefore couldn't work. Again, you can look at the numbers here, maximum credits of 5 or 10 grand per employee. So to the extent the banks are participating in this or pursuing this, there certainly seems to be some significant potential credit dollars involved here. And again, just to remind you, there will be some adjustment on tax returns for these credits. So if you're participating in them or pursuing them, then we need to know about that. Nate, you want to take that over?
Yep, great. Thanks, Paul. We just want to quickly touch upon merger and acquisition activity. One, because we have had a couple clients over the past couple of years enter into an M&A transaction, and two, with the downturn in the economy, there could be some benefits to buying an entity at terms that are more favorable than they had been in the past. So from a purchase accounting standpoint, when a transaction takes place, an opening balance sheet will need to be performed. This is something that's not necessarily straightforward, and our clients don't normally do this on a daily basis. So it is something that they should engage an auditor and accounting expert like Monadeo to help with. And this would include establishing, amongst other things, appropriate deferred tax assets and liabilities. From a transaction cost perspective, as part of a transaction, transaction costs are normally significant. From a financial reporting perspective, these are normally expensed as incurred, whereas for tax purposes, they're normally capitalized if they're considered inherently facilitative. Inherently facilitative just means costs that are directly related to making the deal happen. One important point we want to make is related to success-based fees. So while most transaction costs are capitalized for tax purposes, success-based fees or fees paid to investment bankers that are only normally paid upon a successful completion of a deal, the IRS allows a safe harbor that allows 70% of these costs to be deductible on the tax return, and only 30% have to be capitalizable. And the only thing that needs to be done on the tax return is to put a disclosure in there in an election notifying the IRS that the financial institution is taking advantage of the safe harbor. And in terms of M&A activity, a couple of our banks that did go through a deal in the past year, they normally were profitable, but because of the significant amount of transaction costs and executive comp payouts, they actually did incur NOLs. And they were able to carry these NOLs back 5 years to take advantage of that 5-year carryback as part of the CARES Act. So that's just an important distinction to make if you're going through an M&A transaction in 20. Next key consideration is in regards to executive comp and deferred comp agreements. Many of our financial institutions have many of these agreements in place, and they operate as intended. Without much thought, but if a financial institution does go through a transaction, many of these agreements can be triggered upon a change in control, and if they are triggered, the golden parachute rules under 280G and the deferred comp rules under 409A can kick in, and if they do kick in, there are significant penalties, up to 20% of compensation paid. So the takeaway here is ahead of time, even if you're not anticipating a transaction to take place over the next year or two, it doesn't hurt on an annual basis to review all of your executive comp agreements to make sure that they are in compliance with these provisions, and this is something that we can certainly help with.
And one other item, a year ago there were a new concept called reportable policy sales of BOLI. And I know we're running late, so I'm not going to get into details, but if you're the acquirer in an M&A deal and you do acquire some BOLI contracts that are obviously in existence and not newly issued, then you should definitely raise some questions, because ultimately we want to make sure you jump over all the hurdles so that you don't put into danger any possibility that upon receipt of death benefit that those might be deemed taxable. So again, it's The buzzword there was a reportable policy sale, and again relates to acquisition of existing BOLI contracts, most of the time in an M&A deal. You got another polling question or no? No. All right. I know we're running over, like I said, so I'll be brief. State taxes, I would assume states are going to get more and more aggressive because their revenues are significantly down. I've listed a number over the next 2 or 3 pages. We've listed a number of the Northeast states, and you can roll through those just to review those provisions. But what I want to point out is, again, in search of better yield, I know a number of our bank clients are now purchasing pools of loans. So, for example, you're buying, RV loans or car loans, and whoever you're buying these through is packaging them, and they're coming from Connecticut, or they're coming from a whole host of other states. So, if you're holding loans with collateral in other states, do you have economic nexus in those states? What other state requirements, or what other state or potential state filing requirements do I have? Again, for purposes of your financial statements, any one year is probably highly immaterial compared to your apportionment percentage in your home state. Whatever is going to be apportioned to other states is not significant. The issue becomes 5, 6, 7 years down the road, if you had a filing requirement because you exceeded their minimum nexus provisions. If you had a filing requirement and you didn't file, the statute of limitations never runs. And then instead of having a $7,000 or $8,000 or $2,000, whatever the number is, tax liability, which again, from an audit point of view, is highly immaterial in any one year. 5, 6, 7, 8 years from now, they could theoretically come back and say your statutes are all open. You owe us, $5,000 for 7 or 8 years plus penalties and interest, and then that's a sizable number. So that's really the danger, is long term. But the takeaway you should have is, if the more you're getting into potential loans in other states, then run a revenue by state report and do some analysis to make whatever business decisions you want to make for purposes of filing in those other states. Do we have another polling question or no?
No. Last topic we want to touch upon is potential future tax law changes. So as we all know, the election took place recently, and with the potential Biden administration in place, and depending on what happens with control of the Senate, tax law could once again change over the next couple of years. And we don't know what's going to happen. If we did, we wouldn't be here today doing taxes most likely. But what Biden has outlined is, amongst other things, he would like to raise the corporate tax rate potentially up to 28%. And so what this is going to do is, if a financial institution is in a net deferred tax asset position, this would result in a permanent tax benefit. And conversely, if they're in a deferred tax liability position, it could result in a permanent tax expense. So pretty much the flip side of what happened 3 years ago when the TCJA passed. So tax planning kind of gets turned on its head if tax rates are going to go up. Consideration might be given to actually accelerating taxable income into 20 and deferring tax deductions. That's not something that we would normally think about in terms of normal tax planning, but given the landscape that's out there now, we need to think about things a little bit differently. And then the last thing is, in terms of the Social Security tax wage base, Biden has given some indications that for taxpayers earning more than $400,000, there will be no cap on the FICA wage base, which could be significant for higher wage earners.
And increased costs for the employer.
Right, yeah, exactly, good point. So again, these are just proposals out there. We don't know what's going to happen. But, like Paul said earlier, we need to have our head on the swivel when we're advising our clients, advising you, and you're taking a look at the operations of your business. That's all that we have.
That's all we have. Any other questions, Jamie? I know we're over.
No, we don't have any more questions. Thank you, guys.
All right,
Thank you for joining us this morning. We hope that you found this session informative. As mentioned earlier, you will be receiving the presentation materials and a brief survey next week. If you have any questions, please feel free to reach out to the presenters directly or your contact at Bonadeo. We look forward to welcoming you back for day 2 tomorrow. Have a good day.